right now, as we analyze the markets on this electric Tuesday, December 2nd, the ticker for MongoDB Inc. is lighting up the board at exactly 404.23 USD. We are witnessing a massive, volume-driven intraday surge of plus 75.36, which translates to a staggering gain of 22.91% in a single session. When you see a large-cap software company, a firm that is already a staple in institutional portfolios, suddenly rip higher by over 20%, your immediate instinct might be to assume it is a glitch or a buyout rumor. The expectation for the software-as-a-service sector throughout most of late 2025 has been one of caution, fatigue, and skepticism. The prevailing narrative has been that AI is eating software, meaning that as artificial intelligence writes more code, the value of traditional software platforms will degrade, or that IT budgets are being slashed to fund expensive GPU clusters from NVIDIA. Investors have been conditioned to expect good enough results to be punished and great results to be sold off. But the reality we are seeing with MongoDB today is a complete repudiation of that bearish thesis. The reality is that we are watching a fundamental re-rating of the company's role in the modern technology stack. This is not just a relief rally. It is the market waking up to the fact that MongoDB isn't a victim of the AI shift, it is the engine room for it. The expectation was a slow deceleration. The reality is a violent re-acceleration of their core growth engine, Atlas, and the market is scrambling to chase the move. To understand the gravity of this price action at 404.23 USD, we have to dissect the earnings report that dropped late yesterday and is fueling today's frenzy. MongoDB didn't just beat estimates, they dismantled them. They reported revenue of $628.3 million against an expectation that was closer to $593 million. In a market where a 1% beat is standard, a beat of this magnitude for a mature company is rare. But the real story, the reason you are seeing this green candle on your screen, is the bottom line. Adjusted earnings per share came in at $1.32. The street was looking for something in the range of 80 cents. That is a massive discrepancy. It tells us that the company isn't just growing, it is becoming incredibly efficient while it grows. For investors using Schwab Intelligent Portfolios or those who rely on automated online investment tools, this kind of profitability jump often triggers automatic buy signals because it radically improves the quality factor of the stock. It moves the company from the growth at all costs bucket to the profitable growth bucket, which is the most coveted real estate on Wall Street right now. Let's talk about the specific driver, Atlas. Atlas is their fully managed cloud database service. Think of it as the product that allows developers to use MongoDB without having to manage the servers themselves. The growth in this segment accelerated to 30% year over year. This is the metric that matters. If Atlas slows down, the stock dies. If Atlas speeds up, the stock flies. The expectation was that cloud consumption was optimizing, code for slowing down, as companies tightened their belts. The reality is that enterprise customers are doubling down. They are migrating more mission-critical workloads to MongoDB because it offers a flexibility that rigid traditional SQL databases simply cannot match. This 30% growth number is the signal that the optimization phase of the cloud cycle might be over, and we are entering a new phase of expansion. I want to pause here and ask you a question about your own investing psychology. When you see a stock jump 20% in a day, is your first instinct to chase it because you think it's a breakout? Or do you short it because you think it's an overreaction? Comment below with chase or fade and tell me why. I'm really curious how you handle these massive gap-up days. Now, we need to address the leadership factor. This was the first earnings call for the new CEO, CJ Desai. Leadership transitions are notoriously risky. The expectation is often that a new CEO will kitchen sink the quarter, meaning they will lower guidance and blame the old regime to set a low bar for themselves. Desai did the exact opposite. He came out swinging. He raised the full-year revenue guidance to nearly $2.44 billion. This demonstrates a level of confidence that is infectious. He isn't asking for a grace period. He is stepping on the gas. This is significant for anyone using investment help services or advisory accounts. Analysts love certainty. When a new CEO gives clear, bullish guidance immediately, it removes the uncertainty discount that often hangs over a stock during a transition. It tells the market that the ship is not only steady, but picking up speed. Let's contextualize this within the broader AI discussion. The fear was that AI coding assistants would allow developers to write complex SQL queries easily, negating MongoDB's advantage of being developer-friendly. The reality, however, turns out to be different. AI applications deal with unstructured data, text, images, video, logs. MongoDB's document-based model is natively built for unstructured data. It is actually better suited for the AI era than the rigid rows and columns of a legacy Oracle database. The rise of vector search, a feature MongoDB has aggressively integrated, allows companies to build semantic search and generative AI applications directly on top of their operational data. Today's 22.91% move is partially a recognition that MongoDB is successfully capturing the AI adjacency play. It is not building the models, but it is storing the memory for the models. That is a sticky, lucrative place to be. If you're looking at this from a technical perspective on your individual brokerage account, the breakout above $400 is psychologically massive. We have been consolidating in a lower range for months. Breaking 400 clears a lot of overhead supply, meaning there are fewer people looking to sell just to get back to even. The volume profile today suggests institutional accumulation. This isn't just Robinhood stock trading activity. These are large blocks being bought by pension funds and asset managers who realized they were underweight. When Fidelity or Fidelity Investments funds decide they need to increase their allocation to a stock like MongoDB from 1% to 1.5%, that creates billions of dollars of buying pressure that can sustain a rally for days or weeks. We also have to compare this to peers. Look at what happened with Snowflake or Salesforce recently. The software sector has been a mixed bag. Some are winning, some are losing. MongoDB is differentiating itself by showing that it is a platform, not just a tool. The data platform narrative is key. They're not just a database anymore, they're a suite of data services. This increases their share of wallet with existing customers. If a customer is already using Atlas, it's easy to upsell them on search, on mobile synchronization, on stream processing. This land and expand strategy is working. The net revenue retention rate, a measure of how much existing customers spend year over year, remains healthy, which is the lifeblood of any SaaS model. However, we must remain objective and look at the risks. The valuation at 404 is rich. It has always been rich, but now it is even richer. You're paying a high multiple for future growth. The expectation is that this growth will continue linearly. The reality of the software market is that it is cyclical. If we see a macroeconomic shock in 2026, a resurgence of inflation, or a geopolitical crisis that freezes IT spending, MongoDB will be the first to get hit because of its high multiple. High beta stocks like this fall faster than they rise. Also, the competition is fierce. You have the cloud giants themselves, AWS with DynamoDB, Microsoft with Cosmos DB, who are both partners and competitors. They would love to eat MongoDB's lunch. While MongoDB runs on AWS, Amazon has every incentive to steer customers towards its own proprietary databases. This co-opetition risk is a constant shadow over the stock. For the retail investor using SoFi investing or looking at SoFi stocks for growth ideas, the question is it too late? The stock is up 70% in 6 months. That is a vertical move. Chasing a gap up of 23% is technically dangerous because gaps often get filled, meaning the price comes back down to test the breakout point. A prudent strategy might be to wait for a consolidation, but the FOMO is real today. The market is signaling that it believes the bottom for software is in, and MongoDB is the leader of the recovery. Let's dig deeper into the Enterprise Advanced segment. This is their traditional self-managed software. Surprisingly, this segment also outperformed. The expectation was that everyone would move to the cloud, Atlas, and this legacy part would shrink. The reality is that many regulated industries, banks, healthcare, government, still want to control their own infrastructure for compliance.